And basically, I think the catalyst now is that people they learn the opposite lesson. They basically were like the deficits don't even matter. All those people 30 years ago saying this would be a problem, it's never going to be a problem. And I think the ironic thing is it's starting to have consequences. I would say that some of the consequences have been manifesting at least since 2019, and that there's multiple factors now that are flowing out into the economy, and they have economic implications, they have investing implications, and so it's a big piece of my analysis.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have an incredible discussion lined up, and we're fortunate to have with us LYN ALDEN. LYN provides more than 100,000 investors per month with research information and tools to help them build wealth and reach financial freedom through her research and her blogs. Her background lies in the intersection of engineering and finance. LYN is an independent macroeconomist and analyst, board member, director, partner in a venture capital firm, and a published author. She's been featured in many publications, including the Wall Street Journal, Time, MarketWatch, Morningstar, Yahoo Finance, and so many others. Her most recent book, which can be found on Amazon, among other places, is called Broken Money: How Our Financial System is Failing Us and How We Can Make It Better. LYN, thank you so much for joining us today.
Thanks for having me. Happy to be here.
So let's begin with the huge budget deficits that we're seeing. What is causing the structurally high fiscal deficits in the U.S. economy, and why is the probability of meaningfully reducing them anytime soon so low?
Yeah, it's a good question. And the deficits have been one of the key variables in my investing strategy and macro analysis for at least 5 years now at this point. And the answer is basically that there's a combination of accumulated decisions that have led to this. So some of it is just demographics. We structured certain social entitlement programs decades ago, and population growth slowed down. And now we have a much more top-heavy population. The worker to retire ratio is problematic. So that's a big factor right there. The other one is that as we've run deficits over time, we eventually get very significant public debt to GDP. And we had 40 years of falling interest rates, which offset the rising debt to GDP. But now that interest rates, they had a higher high for the first time in a very, very long time, and we'll see if they get like a higher low. But either way, they're can't really go much below zero. So now they're kind of chopping along in this more sideways pattern. And so any meaningful amount of interest rates means very high interest expense, which is a deficit item. We have ongoing very large military spending, which is and the current geopolitical events are adding to that. And so basically, we have a number of things that are all kind of accumulated to this point. And one of the things I've kind of pointed out before is that in the late 1980s, the debt clock went up, the famous national debt clock. In the early 1990s, Ross Perot ran the most successful independent presidential campaign in modern history, um, largely on the debt and deficit. That was like one of his key things. So that was kind of like the peak zeitgeist for public debts becoming a problem. That's when like we were starting to climb up into the trillions of debt. And interest expense was very high because interest rates were so high. So even on a fairly small debt to GDP ratio, if you have over 10% interest rates, you had very high interest expense. And a lot of people end up being early in terms of how that would meaningfully, be a really big economic impact because we had the opening up of China, we had the fall of the Soviet Union. So we had this like 30-year period, 30, 40 years of globalization, kind of more accelerated globalization. So yeah, a lot of Eastern labor coming into contact with Western capital and all this kind of untapped optimization to do, which benefited some people or hurted other people, because you have manufacturing kind of shifting to very lower cost places. But that was all structurally disinflationary. It allowed interest rates to keep edging lower with every cycle. And basically, I think the catalyst now is that people they learn the opposite lesson. They basically were like the deficits don't even matter. All those people 30 years ago saying this would be a problem, it's never going to be a problem. And I think the ironic thing is it's starting to have consequences. I would say that some of the consequences have been manifesting at least since 2019. and that there's multiple factors now that are flowing out into the economy, and they have economic implications, they have investing implications, and so it's a big piece of my analysis.
I appreciate that answer. And I want to hone in on one of the pieces you talked about, and that was the social services. So, Lynn, one of the starkest visuals of US demographics is the Social Security Administration's projection for when their reserves are going to run out, which currently is projected to be in about 10 years in 2035. The projection, it drops much faster than it went up. And that's even depicted by the administration itself. In your analysis, what do you see happening with Social Security due to this situation?
So I think that's one of the big variables, and it's about 10 years away, most likely. Basically, for many decades, um, there was a lot of money flowing into the Social Security reserves, and they invested in intra-governmental debt. So it's kind of like it's not really there. It's not there's not really a pile. It's not like a pile of gold anywhere that's backing all this up, but it's kind of backed into its own, intra-government debt. And now there's a lot less money flowing into that than is flowing out to payments because of the aforementioned demographics issue. And so that grew to about 3 trillion in reserves. And now that we have structural deficits in that Social Security component, that's drawing down. As you mentioned, we peaked only like 2 or 3 years ago, and they projected to be drawn down by 2035. And they check this every year. Sometimes they've said 2034. You could see scenarios it's 2036. I mean, as you get closer, you find out, and it accelerates more toward the end, because right now you have a 3 trillion pile of treasuries paying interest, and as that draws down, they're paying out obviously less interest, and so it kind of starts falling faster. So right now it's falling slowly. It's kind of deceptive, and then it starts kind of falling very quickly. Essentially, when that runs out, if there's no legislative action, it's not because it's not part of the same pot of money as the rest of the government. If there's no legislative action to redirect, the deficits to kind of cover that shortfall, which is probably likely, but it's not guaranteed, then you could get reduced payouts. Basically, they would be constrained by the money flowing in, which, depending on what demographics look like at that point, Social Security payouts could be cut by 70, down to 70% of what they are now, just because they're constrained by how much dollars are flowing in, which obviously could have all sorts of social implications, political implications, which is why there's a pretty good chance they would just paper over it, but that would essentially be monetized, fiscal spending, or raising taxes elsewhere. A lot of this is locked in. The other piece for why these deficits are so structural is that there's political polarization. No politician really has an incentive to meaningfully cut anything, because it's a good way to get voted out of office. It's, everything, if you look at even polls, like if you say, okay, well, do you want to cut Social Security and Medicare? And people say no. And it's like, well, you want to cut the military? No. Can't cut interest expense without defaulting. Can't cut veterans benefits. And that's about 100% of tax receipts. So then you say, well, do you want to increase taxes? People say no. And then there's even the rest of the government, which is a pretty small percentage of the total pie. The FAA, or the whatever other department, like the parks, right? These are all like these small little things. People are like, no, I want the parks to be there, but that's like almost a rounding error compared to those handful of few items. And so it's just locked in, and people would rather have that, so far at least, they'd rather have that dispersed through inflation than tax hikes plus cuts, or some combination thereof. They've been kind of implicitly opting through, keep the deficits flowing, balance sheets increasing, money printing when needed, so forth.
And complaining the whole way.
Yes.
So so let's talk about tax receipts. The United States tax receipts, they're more correlated to asset prices than most other countries. The tax receipts, they lag on the performance of the stock market. When the stock market goes sideways or down, that tends to be a problematic variable for the following year's tax receipts. We just saw that a couple of years ago. Does this correlation force governmental policy to be asset price protective or even accommodative?
Kind of. I would describe it as it's another variable for why deficit reduction in the US is so hard. It's like hard mode, because in some countries you do see them moderately reduce public debt, like Germany, for example, through austerity measures. The challenge in the United States is that if you because our tax receipts are more financialized than most other developed countries, meaning that our equity market is so big, even the rest of the world's invested in our equity market, and so much of our tax receipts are based on either capital gains or pretty high executive compensation, which is largely tied to equity performance. And so if you get a couple years in a row of sideways to down equity performance, tax receipts fall with a lag. And so if you were to get some sort of, going against everything we just talked about, all the incentives, if somehow politicians got together and decided to enact some degree of austerity, maybe they cut deficits from 7% to 3% somehow, like it's magic. The problem is that you probably would still have bigger deficits than you think, because that would probably impact asset prices, which would then feed back into weaker tax receipts than expected, even if tax hikes were part of that package, unless it was done in such skillful a way to disentangle that correlation, meaning not just tweak a number here, tweak a number there, but more of a structural overhaul, which is very hard to do in any sort of polarized environment. So it basically just it's another layer. It's kind of the final layer for why these deficits are so hard to untangle.
Is there any way out of this? Can they fix this? Is it fixable?
I think not without a currency devaluation. Basically, like, these things historically, like after World War II, the question was how did you fix it? Because we had a similar high public debt to GDP ratio. Back then, the economy was less financialized, demographics were better, so they kind of grew their way out of it. But then they also inflated cash and bonds. So if you were holding cash or bonds, you just got devalued versus everything else you'd want to own: houses, equities, gold, land, all these other things. So generally speaking, you can eventually have basically a period of inflationary kind of dispersion where when you have very high public debts, basically what eventually happens is you generally default, but default can take multiple different forms. If you're an emerging market that owes a currency you can't print, like the dollar, you might actually default, like any sort of corporation. You just don't have the dollars. But if it's in your own currency, the more common way to default is to print the difference and you pay back every unit that you owe, but that those units are worth less. So anybody that was owed does not really get the purchasing power that they expected. If you go far enough in the future, the demographics problem kind of works itself out. Potentially, we don't know what things look like decades in the future, but eventually you get past that kind of the very large generation moving through the whole retirement system, and you might get to more of a steady state. But I mean, that's we're talking decades in the future at that point.
Mm-hmm.
Um, I think in their mind, they want to grow out of it. So generally speaking, inflation is a little bit less than money supply growth because, at any sort of given 5 or 10 year period, we get productivity growth. We get better technology. We get better at making things. We have robots making clothes for us instead of people making it by hand. And so clothes, for example, don't increase in price as quick as the money supply because the baseline inflation rate is negative. It's not zero, it's negative for many things, especially anything that's reasonably abundant. And so I think in their mind, they're hoping that AI and just ongoing tech developments will offset this kind of background structural inflation. So I think it's a multi-year process. I think it's
Does
just going to be a background issue.
doesn't AI and robotics though present a whole different set of circumstances that the other disinflationary forces through the years didn't, and that is that they can take jobs that can't be brought back?
Kind of. I mean, I think a lot of technologies take jobs. So, I mean, the robots that make our clothes take jobs. Outsourcing things to China takes jobs from Americans. Uh, Generally, what's happened over time is people rotate to other work. It's not clear if this might be the time where it actually starts permanently eating into employment, because if, every time a technology came along, people said it's going to take their jobs. Really, it kind of takes, one generation's jobs, but the next generation does entirely different work. Um, and it's unclear if this can displace enough, say, white collar work, or if long enough, you get robots, you could displace some blue collar work. Um, it's hard to say. That's more of a technological question than an economic one. I think in the next 5 years, kind of any sort of investable time horizon, the impact can only hit so quickly. And another factor that makes this challenging is that a lot of the deficits are inflation adjusted. So Social Security has a COLA increase. Um, the Medicare and Medicaid parts are kind of implicitly inflation indexed because they owe you a certain amount of medical services. And so, I think that AI can, for example, they can iterate on, molecule folding and they can make some breakthroughs, I think, with some iteration in AI. But I think overall, um, this is just a long-term thing that's going to be worked through. And one of the analogies that I make is that in emerging markets, sometimes emerging markets will have a 5 or 10 year inflation problem. It's like it's just a background thing that's happening, and everybody just kind of adjusts to it. And it seems like a crisis, but then years later, it's still happening. And I think that a lot of these developed countries, with their very high public debts and their problematic demographics, it's just going to be a background problem for quite a while. I don't think there's going to be one year where we say like this was the debt crisis finally hitting. It's like we're going to, I think, look far in the future back at a time period where we said that was where the demographics and the debts were a problem during this pretty long time period.
Okay, yeah, I'm thinking of the fourth turning and that
Yeah.
time span. Yeah, as you're talking. So you recently stated online that whoever wins the election is basically being handed either a recession or a reaccelerated inflation, and there's nothing that they could do about it. And in other words, nothing stops this train. The deficits will be big, the consequences will be profound, and yet little will change this decade except around the margins. So strap in. Would you speak into that statement for us?
Yeah, so like a lot of things we just discussed, it's like 80% of the deficit is pretty much locked in. And the interesting thing is that neither party is really talking about deficit reduction that much anymore.
No.
So if you go back to, say, the Paul Ryan era of the Republican Party, so if you just go back to the prior decade, meaningful reforms of Social Security and Medicare were kind of part of that. And they just weren't particularly popular, and they just never really got through. But that was kind of a differentiator between Democratic and Republican priorities. Now you see in the 2024 Republican platform, no cuts to Social Security or Medicare, and no increase to the retirement age is in the platform. So that used to be a Democrat position. Now it's a Republican position. Democrats agree with that. And so one of the few things that the very polarized political environment agrees on is don't meaningfully cut Social Security, Medicare, military interest expense. They want to debate which country should get more military aid, but not whether or not we should really reduce military aid. Except for there's some more libertarian candidates, but the majority kind of the centers of both parties
Mm-hmm.
are not really in that. And so a lot of that is just structurally locked in, and a lot of it is, like, again, based on decisions from decades ago. People debate whose fault is deficit. Is it Trump or Biden? And it's like, well, no one says, was invading Iraq a good thing, right? Because if you do the numbers, like I think Brown University estimated that's costing us like $8 trillion when you consider like everything together, the whole war on terror, the domestic changes we made, the interest expense on that, the decades of veterans benefits we now owe because of all those activities there. So there's different ways to measure the exact cost, but they place it somewhere around 8 trillion, and that's now we're kind of paying that interest expense. And these are just accumulated decisions that build up. So I think that, around the margins, they proposed different taxes. Trump proposed tariffs, and Harris proposed different types of increased capital gains taxes and things like that. They also both of them proposed certain tax cuts. And I think that's where the polarized Congress comes into play. I think the polarization cuts off the tails, meaning that it makes very giant tax changes unlikely. One of the more likely ones potentially is that there are some Trump era tax cuts that are set to expire in 2025. And which administration wins could have a more meaningful probability of whether those get renewed or what they look like when they get renewed. So around the margins, it's not like elections don't matter fiscally, but it's just that I view 80 to 90% of it is locked in. And if anything, most of the political stuff is aimed at less economic issues, more social issues and more geopolitical issues, and
Yeah.
less about the fiscal side.
So, what about the consequences, though? You said that the consequences are going to be profound. Are they profound for the country in terms of just massive debt because of the annual deficits getting bigger? Is it profound because, those on the ground are going to feel something in particular?
So I think we're just going to have kind of a bare minimum, like high single digit deficits as far as the eye can see. If you get some sort of crisis, you can go back into the double digits, but kind of the baseline now is that 6 to 7%. Um, and part the way that manifests partially depends on those productivity growth rates that we talked about before. So if you don't get a lot of productivity growth and you get pretty high structural fiscal deficits that eventually are being monetized by the Fed again, they're not right now, but they like basically when you project out by the end of 2025, they'll probably go back to balance sheet increases. Um, and if you don't get a lot of productivity growth, that can show up in inflation, right? So if there's any sort of like energy supply issues or um, not a lot of technological productivity growth, and a lot of that can show up in price increases. If you do get some combination of, there's plenty of energy supply hitting the market, these uh, kind of offshore developments that have been happening recently have been pretty promising. But let's see you keep the energy flowing pretty well, and AI starts, lowering the cost of just various kind of services. Then you get instead a bigger range of how it shows up because things that are more truly scarce generally increase roughly at the rate of like money supply growth, um, whereas other things are not. So, for example, look at the past 20 years, waterfront property is generally going up at the rate of like money supply growth, whereas clothes are not because they're being, their baseline inflation rate is probably something like -6% a year. So you're getting, 6 or 7% money supply growth, and you kind of balance out. You get a shirt roughly costs what it did like 20 years ago in many cases. So you get that really big differential between different types of prices. So things like healthcare, things like certain services, things like certain rare assets are going up quite quickly, and then a couple of key pockets where there's faster productivity growth or just faster ways of making them cheaper are not going up as quickly as people might expect. But then people are still like they'll feel that the CPI is understated because like right now, for example, when you look at the CPI and you say, okay, we're back under 3%, but then we look at housing affordability, for example, it's like through the roof, like very very hard affordability problems.
And that's a much bigger cost factor for an individual family
Yeah,
than
yeah,
clothing.
healthcare, transportation, housing, these are all huge variables. Childcare, and when those go up, people understandably are, saying that the CPI is not really capturing my life properly.
You talked about waterfront property. I just saw somebody had bought this beautiful waterfront property in Miami, and their first year they paid about 75,000 in property tax on it, and they got a re-rate up to over 300,000. So I mean, property taxes are a huge issue, and I don't know that there's a corollary reduction with deflationary items like clothing on the other side. And so
Yeah, I
is the
think
difference being made up in people's salaries? Are they growing as fast as that differential? I don't know.
generally not. It's generally somewhere in the middle. So sometimes you'll see proponents of basically people saying things that are fine now will say that wage growth has outpaced CPI over a given, set of years. But again, there's a long tail of things that are getting cheaper, TVs and shirts. But if you compare incomes to housing prices, that's generally been insufficient. Housing affordability has gotten worse over time. Same things for healthcare, childcare, anything that's not automated, outsourced. That's where the kind of the cost pressures have been. Education, like tuition, maybe we'll see that disrupted in the coming years, but so far not really. And so these have all been areas that have impacted the consumer. And one of the differences between developed market recessions and emerging market recessions often is another way of saying disinflationary recessions versus inflationary ones. So when we think of a disinflationary recession, let's say 5% of people are heavily impacted because they lose their jobs, and 95% of people are not impacted that much at all because they kept their job. They're more worried about the job security. Maybe they get a smaller raise, but their life didn't meaningfully change. Instead, it got the pain was kind of in a small percentage of people, but pretty heavily disrupted for those people that lose their jobs. When you have like if crises or recessions in emerging markets, you often get not necessarily an unemployment spike, but everybody's worse off. Like their currency falls 30% compared to the dollar, and so all their import costs have gone way up. They can't travel outside of the country as easy. They can't buy cars as easy. They can't buy computers as easy. Um, everybody's food prices relative to incomes are up, and it's this more dispersed pain point. And that's kind of what we saw in 2022. When you look at things like consumer sentiment or the misery index, they actually had recessionary numbers on them, even though we got no NBER defined recession. And that's, I would say, in large part because it showed up in that debasement rather than that unemployment cycle. And so these are kind of characteristics of fiscal dominance, this kind of background, very large deficits that make recessions sometimes feel a little bit different.
Yeah, I'm feeling the boiling frog analogy as you're talking. So, Lynn, after the Russian invasion of Ukraine and the subsequent sanctions that were put on them, many countries moved away from treasuries for their reserves and towards gold. This trend seems to be picking up steam and spreading to more and more countries. In your analysis, what's this telling us about the future of the global financial system and the changes that we should expect here in the US?
So we already saw this for about a decade. So China, for example, back around 2013, announced that accumulating treasuries is not really in their best interest anymore, and they started doing the Belt and Road Initiative instead. So they would take the fact that they're running structural trade surpluses, and instead of plowing them into more treasuries, they would plow them into like loans to countries around the world for commodity deposits or infrastructure or whatever the case may be. Um, and when you kind of look at that pattern, they've had sideways and then eventually falling treasury holdings during that whole period, nothing new. Um, and then, as you mentioned, the invasion of Ukraine and then the freezing of Russian assets and then debates about confiscation and all that, that a number of countries that are, sometimes on friendly terms, sometimes not on friendly terms with the US. They're thinking maybe we should diversify more. A lot of this was already in place. So I was already writing about this trend in the years before that invasion. But I think it kind of lit a fire a little bit under some of these efforts that were already in place. I mean, obviously, in particular, Russia had to de-dollarize a lot of their international payments, for example. So their payments with China quickly became de-dollarized out of necessity. And just the BRICS countries in general and the Shanghai Cooperation Organization countries in general have kind of accelerated some of these other payment methods. So I think that over time, and then as you point out, that there's been a pretty big uptick in gold accumulation among central banks. That's another trend that kind of has been in place for a while. So if you look at the decades leading into 2009, you got kind of falling central bank holdings of gold.
Mm-hmm.
And around 2008, 2009, you started to get that increase in central bank tonnage of gold. Some years it would stall a little bit, but these last 2 years have been very strong for central bank purchases. And I think that makes sense. And I think we're seeing that manifest in price. I think countries basically have two main options. They can diversify uh, their fiat currencies among a bunch of different central banks so that they have fewer tail risk associated with just the dollar. Or they can add more gold to the mix, or a bit of both. They can say, well, instead of the dollar being 80% of our holdings, we'll reduce it to 50, and we'll fill the gap with gold and a couple of our major trade partner currencies and things like that. So you get that kind of a little bit more multipolar setup.
I think back in the 60s, 70s, the central banks were holding maybe as high as 70 to 75% of their reserves in gold. And then, as you talked, it dropped at the low point in 2008, 2009 into the teens, like the low teens. And I
Yeah.
think now it's maybe in the higher teens, but it's still got a long way to go in terms of accumulation before them. Would you agree?
Yeah, I think so. I think we've seen the bottom in the percentage, and obviously this is both decision making and price changes. And so I think, but over time, I do expect that number to increase. I think they, especially for the long term part of reserves. So some reserves they want to be able to trade in and out of very quickly. so they like the liquidity of something like Treasuries. But for the part of reserves that they hope never to really tap into, certainly some of those longer term, more debasement resistant assets like gold are useful. I mean, most estimates show that the above ground refined gold supply increases by 1 to 2% per year, whereas a typical fiat currency, developed market currency increases by 6 to 9% per year. Um, and then you can factor out the yield you get. So I mean, in an environment where you're getting paid a 5% yield and the money supply is growing up by 6%, that's not too bad. But if it's kind of one of those other types of environments where it's growing by 7% a year and you're getting paid 2 or 3%, your like dilution rate is worse than gold, which is only 1 to 2%. So I do think it makes sense for them to have a larger share now that the major alternative asset, treasuries, is associated with a country that's kind of stuck in persistent fiscal dominance.
Let's talk about the Fed and their actions yesterday regarding their decision to cut 50 basis points. Did the Fed just open up Pandora's box coming out with that 50 basis point cut, which hints to the markets that either the economy's in worse shape than being reported, or they have to get ahead of this colossal wall of debt that's maturing? They're doing this all while at the same time real estate, stocks, and food prices, like we were saying, are all at all-time highs. In your examination, will this unleash a new round of high inflation? I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Lynn as much as I have. Please let her know. Hit that like and subscribe button and leave a comment below the video.